of the Capital Raising Club. I'm here to help make sense out of business, investments, and capital raising. Whether you're an entrepreneur or an investor, this show bridges the gap between investors and business owners with interviews from business leaders who have experience on both sides. Make sure you follow us on Facebook at Capital Raising Club. You can watch our previous episodes and sign up for our newsletter at our website at capitalraisingclub.com.
And now here's the host of the Capital Raising Club, Rose Vitale.
Started. Well, greetings, guests, and thanks for tuning in on Capital Raising Club radio show. It is brought to you by Rose Vitale, who is the co-host and the founder of Capital Raising Club. And I am John Tabor. I'm the co-host of the program. Rose is in Hawaii, relaxing on the beach. So I am going to be doing the show by myself today, along with my guest, Doug Ruach. And next week, Rose and I switch it off. I'll be on my way to Miami and the Caribbean, and Rose will be here. And then the following week, we will both be back on the air together. Now, the Capital Raising Club is leaders in creating strategic partnerships and relationships between investors and those who are in need of capital for a variety of projects. This could be a business enterprise. It could be any number of other worthy activities. It is one of those places that I would compare to a dating service. I know that may sound a little crazy, but I am a successful user of dating services. My wife, Nancy, and I met through one 6 years ago, and we are doing just great. So what we are all about is putting the investor up on our website, along with key persons who can help us assess different projects. And we put up information about persons who are looking for money and who have all the necessary credentials to back up what it is they request. And then we have the persons such as Doug, who are experts that we call on to help everybody come to agreements and put together necessary business arrangements. Now, Doug is the president and founder of Regulation D Resources. He founded it along with 4 partners in 1999 with the purpose of providing Regulation D exempt offering advisory services to corporate clients. Regulation D Resources services the Fortune 500 level clients, as well as smaller startup and developmental stage companies. Now, the company Regulation D Resources is specially focused on the real estate, energy, and technology sectors. Doug, welcome to the program.
Well, thank you.
Doug, why don't you tell us a little bit about yourself in terms of your relevant experience and, how did you ever get into doing the business?
Absolutely. When I graduated from college, I decided that I wanted to follow the entrepreneurial route, and it was at that point that I went out and started a commercial mortgage brokerage and built up a portfolio of deals, and at that point ended up then merging that company into a company that was executing Regulation D private placements at the time, and that's really how I got my start in Regulation D offerings and the kind of the inner workings of the securities code.
Okay. Please tell us what Regulation D stands for. It sounds mysterious.
Sure. Regulation D is an exemption that was created by the Securities and Exchange Commission back in 1982. And essentially what it provides is it provides an exemption from having to do a fully registered securities offering. And really the goal for the program was to create a streamlined pathway for mainly private companies, although public companies can use it, but it was mainly intended for private companies that wanted to go out, raise capital from investors, engage in security sales like common stock or promissory notes, and provide them a more efficient pathway to do it than forcing them to go through the, fully registered route, which was expensive and laden with a lot of compliance burdens to get the offering to the point where it was ready for execution.
Now, is this something that everybody in business should get into? Do they need it?
If you're going to go out and raise capital from investors, you're going to need a securities offering. It doesn't necessarily mean that you would file under Regulation D. There are some other programs available, but Regulation D tends to be the most straightforward program to execute under. And, each year I think it varies, but I would say anywhere from, 1.4 to 1.8 trillion in capital is raised under the program each year. And so I think really the litmus test there is if you're going to go out and solicit investors to invest in your company, whether it's on an equity basis or whether it's a debt basis, you're probably going to need a securities offering. And Regulation D then is going to be your most straightforward path to execute that securities offering and stay in compliance with state and federal rules.
Okay. So how do people learn about this? If they're brand new into this field, how do they find somebody such as yourself?
Well, a lot of times we get referrals in from business attorneys, CPAs. A lot of times the entrepreneur themselves, they're aware of Regulation D securities offerings. They may have invested in one before, or they're maybe just in doing their research on how to raise capital. They end up running into, the existence of the program. I think the key thing to understand is when an entrepreneur goes out to raise capital, typically what they're going to see is that, you need to put a business plan in place and then, you pitch that business plan to investors. And unfortunately, it's really missing a key part there, and that is the securities offering. I mean, it's important to have a business plan. It's important to obviously have information about the business and its forward operations. But in order to actually accommodate the investment process, you need to have a securities offering in place and obviously then make sure that offering is going to comply with state and federal rules. So there's a number of ways that people end up finding out about the program, but a big part of what we do is educational in nature. Perfect example is this interview. Being able to get out and educate people on the fact that not only do these programs exist, but it's in your best interest to use them so that you avoid having any kind of compliance issues down the road.
Well, that makes sense to me. I know the first time I went out to raise money was in 1975 when my wife and I started a company in Palo Alto, California. And we did not know about such things at that time. I did engage an attorney, but he never mentioned it. And it was funny. I kind of stumbled into it along the way. And finally, I started asking the right questions, and I found out what I needed to know. But, it's funny, but oftentimes when entrepreneurs get together about, I'd like to start this kind of a company or that company, the subject of Regulation D hardly ever comes up. They talk about business plans, they talk about where to raise money, but in my experience, oftentimes that may be the last subject they think of. Is that the way you've discovered it too?
Yeah, it's interesting. We have a lot of people that engage our firm that have actually been out trying to raise money with a business plan and typically end up frustrated. And I think that the dynamic that you've got to study there is that the business plan is only going to provide certain things. It's going to provide information about the company and what have you, but it's not actually going to provide a mechanism and a structure to accommodate individual investment. So if you're seeking $3 million for your startup software company, unless you've got a securities offering in place, it's going to be very hard for the orthodontist down the street that's got $50,000 that he could potentially invest. It's almost impossible for him to accomplish that investment, and nor would it even be apparent to him. You know, he's going to read the business plan. He's going to see you're looking for $3 million, and he's going to say, well, gee, I've got maybe 50 grand I could put into that, and I really can't help this person because I don't have a $3 million check I can cut. So a lot of times people, they head out, they start promoting the business plan, they get frustrated, and then the next thing you know, a lot of times they do a little bit more research and then find out about securities offerings, find out about Reg D, and then that's when they end up at our doorstep.
Well, that's a good description. Thank you. Now, I've heard the term PPM. What does it stand for?
Private Placement Memorandum, and that is the disclosure document that is utilized in a Regulation D exempt offering, and that document is there to disclose all of the pertinent details and facts to the investor regarding the company, the management team, forward operations, the company's history, financials. So it's the disclosure document that the company would use with prospective investors to make sure they get full disclosure.
And is that something that your company would provide?
It is. We draft the private placement memorandum documentation for our clients.
Okay. And if they were going to want to engage you for that, let's jump in and find out what your website address would be so that people could go find you. Absolutely.
So the company name is Regulation D Resources, and our URL is www.regdresources.com, and they can also use www.goregd.com, and both of those will lead right to our corporate site.
Okay, excellent. All right, so if a company determines that they need a PPM, how would you do it different than other companies that might provide the same kind of service? What's unique about your offering?
Sure. So as far as the development of the offering document, I like to look at it from two standpoints. The presentation aspect of the document, how is the information being presented, how is it formatted, and then the second side is really the technical side, as far as technically are we disclosing everything factually that needs to be disclosed to protect the company and protect the investor. So on the first side, the presentation side, that is something that really sets us apart from other firms. Pretty much everybody else in the industry, they're going to do a templated text Word document for the PPM. We really create something that's completely different. We create a very high-end piece for the client. It has a graphical and branding component to it. And it also has a front section that we build in prior to actually getting into the PPM that's there to engage the investor prospects and provide them with some summarized details on the company. And then from a technical standpoint, we draft our documents using the Form 1A standard. And Form 1A is a Securities and Exchange Commission standard that they use in Regulation A and other registered type offerings. So it's an uprated disclosure standard. We use that standard and follow that model because it protects our clients better. It also tends to be the disclosure standard that broker-dealers require, and that is a benefit of putting the offering in place, is it does then open up the securities professional community to you as potential resource for accessing retail investors.
Okay, that sounds good. Now, if somebody wanted to engage your company, how long would it take to create the PPM and all the related documents?
Sure. A lot of that is really dependent on the client. You know, as far as the process to have the client ready to execute security sales, you know, internally we're looking at A, onboarding the client, B, working through a lot of the initial structuring, C, drafting the offering documents, and then really positioning the client so they're ready to go out and start executing sales. And at that point, then the federal filing, we would go ahead and take the client through getting that in place. So a lot of it is dependent on the client as far as how responsive they are in getting us information, but also the complexity of the deal. It could be as short as 3 weeks if it's just a very simple single asset real estate deal where they're raising money to just purchase a multifamily property. It could be 6 weeks or longer if it's a deal that's more complex, or if the client isn't really necessarily in a rush to get us information, and we're getting information over a period of a couple weeks through the process.
I had visualization of somebody pulling teeth. Sometimes it's difficult to get information out of people who have never been asked to do it before. Do you ever run into that?
It is a challenge of the business, and actually we train our staff and underwriters in the process of getting the proper information from the client. We actually have a lot of stock content in place too. So for example, if someone's going to come through and do a real estate fund, we actually have a lot of stock content we can provide that will put them 60%, 70% of the way home to having finalized content. But that is a big part of putting a proper PPM in place, is what information is needed. Are there related party-owned companies that are providing services to the company that's actually raising capital, where we need to disclose that? So again, you kind of go back to the technical and the narrative side. Technically, there's certain things that just need to be disclosed to make sure that investors understand the company's operations and that full disclosure is being made. But you also have to look at it from the standpoint of, are you telling the story of the company in that disclosure as well? Is the orthodontist down the street reading this document, is he going to understand your company's business and your operations and understand the opportunity? So at our company, we really view the development of the PPM through those two different lenses. Have we developed it so it's telling the story properly and is really providing a solid indication of the opportunity? And then obviously B, which is just the factual technical disclosure, making sure that everything that needs to be disclosed on a factual basis is being disclosed.
Okay, so let's say that I wanted to engage you to do this for my company, and how would I commit to something like that? Is there down payment required, contract payments? Is it all paid in full? What is something very typical in terms of a project that you might take on?
Sure. So we actually have two sides to our business. We have our offering preparation and execution service. That is our core business. It's what we've been doing since 1999. That's all the structuring work, document drafting, taking the client through their filings at the state and federal level, providing them access to our broker-dealer assets, and then providing them full compliance support through full execution of the offering. That service is a flat fee. It's $7,000. It's paid $3,500 to engage us, and then the balance of $3,500 is due 30 days net from that date. So they'll pay half. We get started on preparing the offering, and then from there, the second payment would be due 30 days hence. And then the second side of our business is our web portal application. We actually have our own software application that tracks and manages all of the subscription processes. So it takes people through all the prospect activities as far as evaluating the offering, accessing the PPM documents, accessing critical information. There's then an invest feature, so it'll take them through the actual investment process, take them through executing all the subscription documents. If it's a 506C-based offering, it'll take them through their verification. There's also an investor relations hub in the back end, and then there's a admin side that actually has features that allow the client to manage the entire offering. So for that software, if the client wants to use that software to manage all the processes, that's a $3,500 build fee, and that's the front-end website build and then the back-end software build. And that is a discounted rate for our clients. So if you've come through and done offering preparation with us, you actually get a discount on that build fee. And that's paid $2,000 as a build deposit, and then the balance is due 60 days net or when the portal launches, whichever comes first. And then from there, the ongoing fee on that's just $30 a month, and that's covering your hosting and software to run that portal on our servers each month.
Well, that sounds like quite an interesting deal. And I'm pleased to hear that you will do the hosting, because that's oftentimes is a dilemma for people. And further, one of the first questions that a person wants to ask is, well, how do I distribute this? How do I reach out to people who might be potential investors? Do you provide some of that service too?
Yeah, and speaking to that, that's where the 506C exemption created such a huge advantage for people using this program, because prior to the 506C program launching, which came in under the Jobs Act, and it was about a year and a half later the SEC launched it, so it's been around for about 5 years, maybe a little longer. That program allows you to generally advertise and generally solicit the offering out to the public. It would be only accredited investors that participate, but that tends to be what most people want anyways as far as their investor base. So when we have a client and they are evaluating the various programs that Regulation D provides, because there are 3 programs, 3 exemptions under the master umbrella, a big decision item that they have is, do I want to be able to generally advertise and solicit people and do social media promotion and press releases, or am I going to do a traditional private placement like a 506B or a 504 where I'm not allowed to do any open solicitation? And in fact, best practice would be that you have a pre-existing relationship with whoever invests. So as far as the capital access channels that we have a broker-dealer asset base we've built up over the years, FINRA broker-dealers that sell private placements. But if the client is also doing a 506C, now it enables us to also share with them the tactics and methodologies that we've seen other clients use to go out and get maximum exposure for their offering and raise money.
Okay, good. Now, you've been tossing around a lot of numbers, and probably there are some of the listeners who are wondering, I don't know what he's talking about. Is there a source that you provide where they can go find out what all of these numbers mean?
Sure. So I would recommend, on our website, we actually have a section on our website regarding the Reg D programs. And again, we really approach this from an educational standpoint as far as the front end of our business, just because it does take some education. A lot of times people approach us, they've never heard of Reg D before. It's been recommended to them by their attorney or CPA, but they have no experience in it. They have no idea, what even constitutes a Reg D offering or the options. So our website does have information on the programs that are available and the differences between the programs. There's also the SEC's website. They have a small business section, and that also can discuss the options that are available to a company under the Regulation D program.
Okay, sounds good. Now, if I'm a small business operator, do I need to go secure a securities attorney to help me do this, or can I engage with you directly and be assured that I'll be safe and go through the process without any undue risk?
Yeah, where we really recommend counsel is a good business attorney that can make modifications to bylaws or create employment agreements or maybe make modifications to an LLC operating agreement. The work that we do is compliant. We've got an unblemished compliance track record over 20 years. So there really isn't a need for someone to engage securities counsel. In general, they do need to obviously bring on board professionals that have experience in doing this. And I think as far as legal counsel goes, there are a lot of times decisions and structure and things that get developed in the preparation of the offering that are going to impact constitution documents, your bylaws or your operating agreements. So I think that's where it's helpful to have a good business attorney on board that can make those changes. The other thing that we've seen too is just corporate cleanup things, like employment agreements. You know, if you've got a CEO and a vice president and they've started a corporation and now they're going to go out and raise capital, they may not have had formal employment agreements before between themselves and the company, but now that you're going to go out and raise money and bring on board outside shareholders, you really want to start cleaning some of that stuff internally up, and that's where having a corporate attorney maybe draft some employment agreements would be beneficial.
Yes, I would agree with you. Doug, what's to somebody who's going to raise money for the first time, what are the relative advantages or disadvantages of debt versus equity? What would you say about that?
Sure. So the rule of thumb that I like to use, and it is just a general rule of thumb, but I think it helps people understand better the differences, is if you're looking to sell the upside of the business, you're probably going to need a pathway to common equity, meaning we've got our software company, and in year 5, we're planning on having $42 million in revenue, and we're going to have a valuation that's, $410 million. You're selling the upside of the company with that story. So in that regard, you're probably going to need a pathway to common equity, because common equity is really where people are going to benefit from the accretive value that's getting built into the business. Where I think debt works well is if you have, for example, an existing business that's stable, seasoned, it's been operating for 20 years, and maybe they just want to raise a little bit of working capital, but they really don't want to go into their local bank to do it. They'd rather just raise it for some private investors, and so they issue some promissory notes to investors to raise some capital. The problem with just straight notes is, they're not participating in the upside of the business. So I've got a note from the company, I've got a debt instrument in place, I'm getting paid, 8% annualized, and there's a 2-year maturity, so at the end of 2 years I get my principal back, but I'm not benefiting from any of the accretive value or the success of the company. I'm just getting that set interest rate. So that tends to be the rule of thumb I like to use, is if the pitch is you're selling the upside of the company, you're probably going to need to have some type of pathway to common equity to allow those investors to benefit from that.
That's a good explanation. That's probably the best one I've heard in quite some time. What would you say to someone who says, well, I think I need some money, but I'm not sure how much I should go for? How do you deal with that kind of a question?
Sure. Well, one of the things that one of the things that we review actually in the first phase of our process with clients is a data point called the minimum offering amount. A lot of people have a handle on the maximum they want to raise, but there's also usually tends to be a minimum offering amount built into these deals. As far as addressing the maximum, typically what I tell people is, it obviously does come down to on a case-by-case basis, but that maximum offering amount that you're going to raise is obviously going to fund certain objectives. And a lot of it just comes down to how many objectives and what's the time frame, because the mistake that I see people make is they'll want to go out and raise $4 million in their initial round. But when you look at their use of proceeds and you look at the timing on use of proceeds, they're not actually using a lot of that capital until month 18 or month 24. Well, there's no reason to raise that capital in the first round. The first round is your most expensive round. You've got the lowest valuation. You're going to have the most unattractive terms, at least as far as the valuation goes, and unattractive to management. So as far as that goes, you want to limit your exposure to the higher cost capital. And in that regard, a lot of times companies will come out with an offering amount that funds certain objectives over maybe a shorter period of time, maybe 10 to 12 months. And then once they've deployed that capital, move the company forward, now they can go out and do a secondary round at a higher valuation and a higher share price to raise the additional capital that they need. So that is, that might be helpful advice for listeners, is kind of analyzing how much capital would they need, and then also understanding that, you can break these into rounds and it actually can be beneficial. The minimum offering amount really is triggered just when you reach a minimum level that you can fund the achievement of at least one objective, and that's really there just to protect investors. That way, if they invest in the offering, they know you're not going to utilize those funds until you've reached that minimum, and if you reach the minimum, obviously you've got enough in hand to at least accomplish a key objective.
Okay, that sounds good. Now, I've heard the term blue sky. What does that mean?
So that is really, that relates to the state filings and state interaction. And this kind of drives back then to the three, looking at the three programs that are available under Regulation D, because two of them actually have a federal preemption benefit. The third one actually is subject to state level rules. So the 504 program, which is an older Reg D program. It's been around for a long time. The 504 program caps at $5 million in a 12-month period of time. It is a program that is fairly frequently used, but it is subject to state level rules. So you file under 504 for your Fed cover, but as you have sales, you have to comply with whatever the state rules are in the state of residency of the investor. The 506 programs, and there's two of them, 506B and C, have a federal preemption benefit, and that's a benefit that got built in to those programs in the National Securities Markets Improvement Act of 90, I think it was 7. So that's a benefit that's been in place for a long time. But basically what that benefit is when you sell through the 506 programs, the federal rules supersede the state rules. And so your interaction, if you want to call it the blue sky interaction, then is really just notification. You're just notifying the state regulator's office that you've got a Reg D 506 in place and you've had some sales to residents of their state. So the 506 programs have some efficiency there because they're not subject to state level rules. You're just doing notification at the state level as you have sales.
Okay. You know, we hear a lot about IPOs. How does that relate to what you do with your advisory advice?
You know, an IPO really is a private company that is now going to, you know, offer its shares publicly and essentially become then publicly traded. How it relates to a Reg D would really be that a lot of the processes are similar. You're not a public company at the end of the process of going through a Reg D offering, but you have followed some of the processes that are inherent in an IPO, structuring the offering and sale of shares, setting a valuation, development of disclosure documents, obviously, you know, the sale of the securities out to the investors. So there's some similarities in the processes. The big difference is with a true IPO, you're a publicly traded company at the end of the process, whereas with a Regulation D, you followed some of the same processes to raise capital, but you're still privately held at the end of the process.
Okay. Now, what if somebody comes to you and says, well, I'm considering raising money by having my friends and family participate? Are there any special warnings that you might give them or advice that would make sure that they don't end up blowing some really key relationships?
Yes. So my advice, I usually, on this topic, I usually start off with the statement that the term friends and family is not in the SEC's lexicon, meaning if it's your cousin or your brother, that doesn't matter to the SEC. And I think the litmus test that I like to use, and again, I like to keep things fairly simple for people that are, you know, new to these programs. You know, John, if you and I decide to open a coffee shop and we both, you know, we both go scout the location together, we both, you know, build out the business plan together. We both put $50,000 into an LLC together to fund the, you know, the build out. There's no securities offering needed for our $50,000 investments because we're both founders. We're both intrinsic to the development of the business, and it's really a founders type capital situation. The moment I go to my college buddy that likes to invest in deals, or you go to a business associate of yours, or even your cousin or your brother and say, hey, would you like to invest? Now we're kind of stepping outside of that founder circle, and now we're actually soliciting people to come in as essentially a third-party investor. And really that's now where you're stepping into needing the securities offering because they're not founders. They weren't intrinsic to the development of the business. They have not had a chance to go scout out the site for the coffee shop. And so now that really is then going to put that company in a position where they're going to need to do an offering.
Okay, well, that makes a lot of sense because with the number of businesses that are launched every year, if we were to think about it, it's quite an amazing number. There wouldn't be enough of you to take care of everybody coming to you.
Well, yeah, and look, it's probably a little bit like speeding on the highway. I know there's a lot of companies that initially capitalize with friends and family money, and they don't technically go do an offering. Ideally, they should. I think the other dynamic that I try and get people to look at is, if you're raising money from friends and family, you really want to make sure you're doing things properly, because if the business fails, if they lose money, that's going to make for some uncomfortable moments at the Thanksgiving dinner table, anyways. But as long as you've done things properly and you did everything according to proper protocols and did an offering, you've at least done everything properly from that standpoint. And that's something I like to stress, is if you are dealing with people that you have relationships, friends, and family, you almost want to go overboard as far as making sure that everything is pin perfect on the compliance side.
Yeah, that's a good way to look at it. One of the things that people read about in the newspapers and magazines and websites and so on is that roughly 90% of all new companies fail within the first 5 years. In your experience, is that a real number? And what is the most likely reason for a failure? Is it money or something else?
That's a good question. It's hard for me to really gauge the accuracy of that number. I can't say it would necessarily surprise me. I think, when I see businesses fail, usually there's a common thread there. I would say that looking at kind of your top main issues that companies have, number one would be that they did not have enough capital to sustain themselves to get the business to the point where it was revenue generating. I think part of the other issues that companies face and ultimately fail is that they don't really have a solid plan for expansion. They may have a good idea. They may have, fostered that idea to the point where they want to launch a business around it, but they really haven't thought through how they're going to market their business or service and get it past that phase. Because the first year or two of a business is a critical juncture. You need to get revenues up to the point where you can cover expenses, and it just tends to be a high-risk time period. And again, that's where being able to raise some outside capital and have a healthy balance sheet is at least going to give you a war chest of capital you can go to if things aren't going as planned in terms of the growth of the business.
Yes, I would agree. Back in my earlier days, I participated in the founding of a company that grew rather rapidly. We went from 6 of us sitting around a table staring at one another saying, what do we do first? To where we had 1,300 employees inside of 2.5 years. And at that time, we were pulling in more than $55 million in sales. The problem was we didn't have enough capital. And we ran out of operating cash, and that necessitated bringing in a partner who then proceeded over the next 12 months to gobble us up, spit us out. That was a rather difficult experience to go through, but one that taught me a lot about making sure that there is plenty of money when you need it for your operations.
Yeah, definitely. I think being undercapitalized, that actually goes back to the equity and debt comparison, and that's another reason why I encourage early stage companies, if they can, to raise equity, because it's going to be cash on your balance sheet. You're not going to have a default risk, because that's something else that sometimes happens is companies will issue promissory notes. They'll do a 24-month note to investors to provide them some a Series A capital. The problem is then the business doesn't grow as intended, and now they're bumping up against that 24-month maturity date, and they've got several million that they've now got to pay back to investors under this note, and they don't have the capital to do that. And now they're stuck in a tough position at that point. They're getting ready to default on notes, whereas if they had capitalized initially with equity, they'd have cash on their balance sheet and they'd be in a better situation.
Well, I wish I'd known you a few years ago. It would have saved a lot of headache along the way. Now, as we're coming up near the end of our broadcast time here, what would you give us a general summary, Doug, that would give people the kind of guidance that they need to consider whether or not they want to go through the Regulation D process, what would you tell them? Let's just say we're sitting around our living room having a conversation about this, and you weren't necessarily in a selling mode. What would you say to them anyway?
Sure. Well, what I would say to them is first identify where you want to raise capital from. That's going to drive whether you need a securities offering or not. And there are companies that benefit from venture capital. They benefit from the connections that the venture capital firm has, the relationships that the VC firm has. Granted, it's expensive money, but it also brings with it a lot of benefits, and a lot of times those are benefits that that company truly needs to grow and maximize its potential. A lot of companies obviously are not interested in venture capital, don't need the venture capital advantages. They're just looking for invested, cash to move the business forward. And in that case, then, if they're looking at going out and raising money from investors, that's where they're going to need the securities offering. And then that's where, when they start evaluating the available programs, Regulation D is going to be really the most straightforward option to execute that securities offering and stay compliant. And then I think the other thing that I encourage people to look at is look beyond just doing a business plan and look at what's required to actually go out and execute an investment transaction with an individual. If you've got, again, the theoretical orthodontist down the street and he wants to put $50,000 into your business, what's required to do that? I think as you encourage people to start looking into the dynamics of that, it leads them automatically into a securities offering and PPM documents and subscription documents, and really puts them then on the right path for doing things properly from that point forward.
Okay, great. Doug, one more opportunity here to give your websites before we sign off with you. Would you please tell our listeners what they are?
Absolutely. So the corporate site is located at www.regdresources.com, and that's REGD resources.com. And then a shortened version that goes to the same corporate site is www.goregd.com.
Well, thank you very much, Doug. You've given some excellent advice. And as I say, I wish I'd met you years ago. It would have made my struggles and my wins more frequently. And, I'm hoping that people really do consider what you've said today, because this is an area where a lot of people wring their hands and they sweat it out and they're really not sure what to do. So I thank you very much for your wise counsel about this. And let me get ready to sign off for this particular meeting today by reminding you that you are listening to this on radio station KCAA. And this is a station that leaves no listener behind. And Rose and I don't either. So we will follow up with you anytime you contact us and inquire about potential investors or projects that we're aware of. We'll take good care of you to make sure that you're not left behind and that we have resources that you can pull as necessary for whatever your project. So next week, Rose will be on the air by herself, and I will be sunning myself over in Jamaica and a variety of other places. And then I'll look forward to rejoining Rose the following week for our next broadcast. So thank you very much for tuning in today. And we thank you for telling other persons about us so that we can build up our listener base. We have important information that we want to share with everybody who is in the business community. Thank you very much for listening. This is John Tabor. Cheers.
You've been listening to the Capital Raising Club with Rose Vitale. Join us each week on